Good morning to all of you. My sincere apology for not being able to present with you at Batlivala and Karani Conference. I'm sure Vikas and Munmun have created a fantastic conference and loss is entirely mine. It gives me great opportunity to share my thoughts on budget and debt markets as I see going forward. The first caveat is that in last 12 months, whatever we predicted on interest rates hasn't come true. If you are charitable to us, you will say that RBI did cut interest rates as expected by you. But no one gives fund manager money to predict what RBI is going to do. People give us money to predict what markets are going to do. We expected yields to soften, and in fact over last 12 months, other than post-budget, yields have actually hardened. Why did that happen? Where did we go wrong? I think we went wrong in anticipating supply-related pressure. We went wrong in anticipating the steepness of curve which is caused by a variety of factors. However, this budget is changing a lot of those things. If I have to analyze this budget, I can analyze in the context of Ramayana and Mahabharata. In Ramayana, Raghu Vanshaj is explained as Raghukul Rit Sada Chali Aayi, Pran Jaye Par Vachan Na Jayi. The descendants of Raghu will always honor their word even at the cost of life. That tradition has been maintained by Finance Minister. In FY16 budget, Finance Minister promised a roadmap to fiscal prudence. The rating agencies upgraded outlook based on that promise. Debt investors put in money based on that promise. This year, there were many temptations to let go that promise. But Finance Minister has honored his word. He has maintained fiscal deficit of 3.5%, and that's extremely important. Now let me stress the importance of this 3.5% using the Mahabharata context. In Mahabharata, many Pandits have summarized that Yudhishthir, by following the right path of dharma, was able to hide many of his limitations, whereas Duryodhan, by following the path of adharma, was able to cover many of his good things. The one good thing of Yudhishthir covered many of his bad things. One bad thing of Duryodhan covered many of his good things. The fiscal discipline is one good thing which can cover many of limitations of India. The path of fiscal prudence, one, allows RBI to cut interest rates. We are living in an environment where Japanese government is borrowing money by receiving interest. The lenders, the investors are paying interest for the privilege of investing into Japanese government bond. Many countries in the world have negative interest rate. In India, if I look at wholesale price basis, the real interest rates are upwards of 8-9%. If I look at consumer price inflation and link it to the borrowing cost, then real interest rates will still be 6-8%. Clearly, we need to lower interest rate, and this fiscal prudence allows RBI to cut interest rates. This fiscal prudence reassures foreign investors that India will be different vis-a-vis its emerging market peers. When others are taking the path of spending, we are taking the path of prudence. This budget also reassures rating agency that whatever commitment we made on fiscal prudence, we are honoring it despite tough times. Hopefully, they will be able to upgrade the outlook and eventually the rating if we negotiate well with them. This budget also opens up the space for re-rating of Indian equity. Between 2003 to 2008, Sensex went from 3,000 to 21,000. Earnings never went up 7 times. Earnings went up little more than 2 times, and the P ratio went up little more than 3 times, creating Sensex to go up more than 7 times. we are in the similar stage where P ratio can be re-rated with the fiscal prudence. This will allow our markets to recover even when earnings are a little bit delayed in terms of recovery. This fiscal prudence overall creates an environment where foreign institutional investors will be more than happy to invest in India looking at its economic fundamentals. If we see last 3 days, the FIIs have turned buyers of Indian equity, and that's a positive sign. From the debt market point of view, I think it is first time in our history that the net borrowing program has come down by 15,000 crore. Before the budget, market was expecting increase in borrowing program from 4,40,000 crore to somewhere around 5 lakh crore. Now we are looking at a net borrowing program of 4,25,000 crore. That's significantly lower supply than expected by the market, and that is reflected into 20 basis point rally post-budget in 10-year government securities. The market, which was worried about the supply of government securities, supply of state development loans, and supply of bonds under Uday scheme, now will have reasonable confidence that with the lower supply of central government securities, hopefully state governments will also follow the path of fiscal prudence, which will result into lower than expected increase in state development loans, and with the clarification on Uday bonds, we will see supply related anxieties of market getting over. Apart from the supply, we had seen one fundamental change in FY16 vis-a-vis the period before. Between FY 2008 to 2013, on an average RBI's open market operations were about 1 lakh crore. In FY16 year to date, OMOs is 22,000 crore. The only two route available to create liquidity in market is either buying of foreign currency or buying of government securities. In FY16, we have seen FII redemptions from equities that has resulted into limited purchase of foreign currency, which means OMOs were very critical for creating liquidity. Our money supply growth has been growing below historical average. Consequently, the credit growth is growing below historical average. And we believe in FY 2017, RBI's open market operation will play a significant role either in lowering the yields or flattening the yield curve. The other important thing in this budget is that fiscal prudence will eventually result into lower inflation, which will allow RBI to keep interest rates lower for a sustainable period of time and also provide much needed liquidity which economy and banking system desperately needs. We expect in FY17 RBI to be more aggressive on open market operations. We expect RBI to pump more liquidity in the system in FY17, and both these things put together along with limited supply can create ideal condition where interest rates can decline from current level. We expect RBI to cut 25 basis point probably in the month of March itself, another 25 basis point towards second half of 2016. The rate cut by RBI and the open market operations along with limited supplies should create an ideal condition where longer end of the curve should come down more than the shorter end of the curve, resulting into a flatter yield curve than what is currently there. In this environment, long duration bonds, long duration government securities, or long duration gilt and bond funds will be more appropriate from an investment point of view. In the month of March, the short end of the curve also remains tight because of the liquidity squeeze. If you are looking at a short-term horizon, then even short-term bond funds will provide attractive opportunity across March. The government is running a fairly large cash surplus. We expect that money to come back into system in the first week of April like it has happened in the past. So across March, investment in short-term bond fund also will be remunerative. The only risk factor for market from a domestic point of view is one, in the month of September 2016, we have to repay $30 billion plus of FCNRB deposits which we had raised in September 2013. We have reserves to repay $30 billion plus deposits. However, such a large outflow could create a temporary volatility in currency market, leading into volatility in rates market. If we can do partial rollover of this FCNRB deposits, then that will ease concerns in currency market as well as rates market. The other important thing from a rates market point of view is on 4th October 2016, Dr. Raghuram Rajan's tenure comes to an end. If the government gives him an extension well in advance, that will soothe the nerves of the foreign institutional investors, that will also mean continuity of monetary policy, and that will again be good from the rates market point of view as well as currency market point of view. So from the domestic point of view, we are looking forward to partial rollover of FCNRB deposits, an extension of Dr. Rajan's tenure, which should then give confidence to both local as well as global investors about continuity of monetary policy. From the global point of view, we have to keep one eye on how US Fed is going to behave. In the month of Jan, immediately after a rate hike in almost a 10-year period, US Fed had warned the market that you are underpricing Fed's resolve of increasing interest rate. At that point of time, they had hinted about 4 rate hikes in US Fed rate. The market was pricing in probably 2 rate hikes. Despite such warning, based on China concern, US 10-year Treasury yields have actually declined from December 15 when US Fed rate was hiked. That behavior is completely contradiction with Indian government securities, where yields have hardened despite a rate cut, and in US yields have fallen despite a rate hike. We'll have to keep a watch on US Fed, how they are going to factor in global concerns into their decision making in terms of normalizing US Fed rate. As long as Fed's rate hike is in line with the market expectation, there should not be any material impact on Indian government securities. The spread between 10-year Indian government securities and 10-year US government securities is above historical average. That gives us cushion. However, we'll have to keep a watch on US Fed's behavior, US Fed's intention, to see how our markets are pricing that in. At the end, I would like to summarize that this budget is like a Yudhishthir budget. One good thing of fiscal prudence should be able to cover many limitations. It creates rooms for RBI to pump liquidity, cut interest rate. It gives room for rating agencies to upgrade our rating. If we negotiate well with them, it's not going to come on its own. We'll have to ask for it. It keeps inflation lower for a long period of time. It encourages FII both in debt and equity side to invest into India. And more importantly, it re-rates our equity market, which might mean reversal in flows, which we have witnessed from June 15 till beginning of Feb 2016. There will be money to be made at the shorter end across March, as government, which has accumulated about 1.5 lakh crore cash balance, spends it in the month of April. There's money to be made at the longer end as RBI's OMO, limited supply, and fiscal prudence results into flattening of curve. It's time to buy long-dated gilts, long-dated bonds, or long-dated gilt and bond funds. My sincere apology for not being there, and I'm sure my fellow colleagues will give you a great discussion on budget, many of its proposals which are quite revolutionary in nature, and how the markets are going to shape up. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.